You're listening to the Real Returns podcast, where we learn how real investments can make a real impact. Join your hosts, Andrew and Dan, as they share stories and interview business leaders on how real estate and other forms of investment can create meaningful change for individuals and communities around the world.
Hi, this is Andrew Reichert. Welcome back to another episode of the Real Returns podcast. I'm joined with my co-host, Dan Croce. Dan, how are we doing today?
I'm doing well. Excited for another day here in the Berg. We always talk about the weather, but it's noteworthy that it is going to rain for 72 hours straight. So that's
we'll be swimming to our next meeting.
Yeah.
Yeah.
But I'm doing well.
Good stuff.
Yeah.
Awesome. Well, excited about another episode today. We'd love to talk about impact investing. And one of the things I really like to talk about is alternative ways to do that. So a lot of people think about real estate investing and they think about, flipping a home, or they think about buying a duplex and fixing it up. Well, our guest today, Chris Seveney, is doing something totally different. And I'm going to let him introduce himself and talk a little bit about what he's doing. So Chris, you go ahead and tell us a little bit about yourself.
Yeah, first, thanks, Andrew and Dan, for having me on today. So our impact investing strategy, like you mentioned, is very different. Most people have never even heard about what we do. And what it is we do is we buy distressed mortgage notes. So many people may have heard of private lending, but, we're on the different tail of we buy loans from banks and hedge funds for borrowers who are behind on their payments. Now, I know a lot of people think that if a borrower's behind by a month or 2 months, they're going to get evicted. The average loan, and we'll get more into this, but I just want to give people some insight as a little teaser here. The average delinquency on our loans are typically 3 to 4 years. People are behind on their payments. So being able to keep somebody in their home that's that far behind can have a significant impact on, that individual, their wealth creation, the neighborhood, property values.
How'd you get into this business?
Because my wife wouldn't let me do other things.
My wife still doesn't let me do stuff.
So
tell me more.
Yeah,
So you were
exactly. So I've been in real estate for over 25 years. Graduated college in mid to late 90s. Aged myself. Worked for a commercial general contractor up in Boston for 10 years. I grew up in Massachusetts, moved down to the DC area where I'm located now. Spent 5 more years working for that company, then got burnt out, working, we were project management and a project executive, so building some high profile buildings, but, the wear and tear of 60 plus hours a week. So I went over to the dark side of working for a developer. And my boss, who I was working for, said, "Hey, what's your portfolio look like?" And my portfolio is nothing. He's like, "You have no, I got my 401k." And he laughed at me. He's like, "Why are you not buying real estate?" So my wife and I bought a house that we knocked down to build our primary residence, had a bunch of equity because we acted as a general contractor, so saved easily 25+%, and started buying some rentals to rehab and basically hold. But at the time, this is 2012, 13, 14, was able to buy some decent properties, but our area is so competitive. And at the time, our kids were 10 and 3. So my wife, after doing 2 of these and spending the weekends all at these projects, my wife's like, "We're done. That's enough." We're working full time. So I'm like, damn, what can I do? Because real estate is so competitive where if you're not looking at that property today, you're not going to get that deal done, and so I'm like, that's what I was good at. So I went on Bigger Pockets and found tax liens. So I played with those for 2 months and then realized man, this is so boring and there's no competitive advantage to tax liens. And people who do tax liens, I'm not knocking the business. There's a lot of due diligence and you can make good money at it, but I needed something that was more, to me, I thought was more strategic. And on Bigger Pockets, the group that has tax liens also had mortgage notes. And I was like, what is this? So I did tons of research, basically, wasn't watching much TV, just spending all my evenings learning about this, and then realized man, banks actually, when people default, will turn around and sell the loans for pennies on the dollar. When we say pennies, back in 2008 to 12, yeah, you could buy them for 10 to 20 cents on the dollar. Times are much different now. where you're probably between 40 to 60 to 70 cents on the dollar, but you're still able to buy it at a discount. So just to be very clear with people, what we're doing is first is we are not buying the property. If you own a home and you're paying, I'm just going to use Wells Fargo as an example, or you should use PNC because you're up in the bird. PNC, sometimes you might get a letter saying, hey, your loan is sold. Please make your payments here. Your loan was sold. Now on the distress side of things, the same thing will happen where they will sell your loan and somebody will buy that to then, they're the bank. So we are basically stepping in the bank's shoes to try and work with the borrower to get them repaying again.
Chris, that's fascinating. So how does it work? Do you have a direct relationship with the bank? And then once you own the loan, are you in direct contact with the borrower? Or are you personally working with them? Or
no, we actually we use what's called a servicing company. So they handle all the payments. They send out all the monthly statements. They handle all of that for us. And it costs us anywhere from $25 to $75 per month per loan. So, if the borrower's performing, it costs us like $25. If they're not, it's $75 a month, but they do all that to then basically be the mediator between us and them to try and negotiate a new payment plan.
Okay. And how do you find the loans? Are you in, do you have a relationship with the bank? Are you buying them onesie, twosie, or do you buy 100 at a time? How does it work?
Yeah, when you get started, you typically buy onesie, twosies more because you're learning, and if you bought 100 without kind of knowing what you fake it till you make it type thing, that would be a little risky. But you start, and again, depends how much capital you have. So typically where you actually find them from is banks typically don't sell directly to an individual, just like Ford doesn't sell directly a car to an individual. They're almost like a manufacturer where they got the processes. And so what they'll do is they will sell them to hedge funds in bulk, which then they'll take a tranche of the ones they like and then, pick apart the ones they want to keep and sell. And typically they'll keep the high dollar ones because it costs the same amount of money to manage a $1 million loan as it does a $25,000 loan. And they only have so many resources. So of course they'll want to keep their prized assets. So that's one, but there's companies out there, the servicing companies that manage these, they might be servicing hundreds of thousands of loans. So we could go to them and say, hey, look, we want to sell these 50 loans, can you send it out to your network? So that's one way. The other is there's companies out there called whole loan traders that basically, same thing, they act as middlemen for the bank to actually, banks will say, hey, look, we need to divest this. So it's kind of like they're a broker, just like a commercial real estate person wants to sell a building. They're not going to sell it themselves. They'll hire a broker to liquidate that for them.
Okay. And Chris, these are non-performing assets for the bank, so I assume you're buying these for pennies on the dollar. What's a typical price you're buying them for?
Yeah, today numbers between 40 and 70 cents, depending on the state. States have very different laws for even within a state. For example, you're in Pennsylvania. The eastern side of Pennsylvania is very different than the western part of the state. In regards to the foreclosure laws and, how long it takes to foreclose. So that has a significant impact, of course, on your pricing. The longer it takes to foreclose, the longer you're holding the asset. So, of course, the less you would want to pay for that to, get that return.
And obviously, your bet is that some of these people are going to start paying again. Is it the case that they're actively not paying when you buy them, or are some of them paying but only partially, or what's the and what's sort of typical of what's going on in the life of the borrower whenever you get the loan?
Yeah, so I'll talk a little bit about the process too of buying, because that adds, I think, some insight, which when you go to buy a loan, it's like buying a house where it's actually even less transparent. We'll get a spreadsheet of data and we'll give an indicative bid just on that spreadsheet. We haven't spent $1. We haven't gone to look at the property. We'll do like a Google Street View, but you just estimate based off of the data they provide you. And then if you get it under agreement, Then you'll run a title report, make sure, what position are you in. You'll have somebody, get a broker price opinion of the property for what it's worth. But you also, at that point, get the servicing comments. So you get the history of all the communications to see what has been going on. And a lot of the loans that we like to buy, we like to buy the property still occupied, not vacant. And B, we like to look at, an event, typically like a one-time event, meaning, COVID, lots of job losses for people who were in the service industry, potentially a divorce, an unfortunate death in the family, a medical sickness. Those are the types of loans where, we believe we can add a lot of value. We've also seen loans where somebody's filed bankruptcy 7 different times. They're really good at knowing and how to play the system. And what they do is, as a husband and wife, the wife would file, then the husband would file, then they'd co-file, then the wife would file again, and the husband, they'd almost go back and forth like ping pong. And the courts would, sometimes allow that. So those types of loans where people know how to, I'll use the term manipulate the system a little bit, or appear to manipulate the system, I should say. We try and stay away from those. But usually, like you said, that most of them are, job loss, 60% of people live paycheck to paycheck. So, any type of income that gets hit like that, they get some default. And what typically happens is the banks will say, hey, you're 4 months behind. I need all 4 months of payments. And so the snowball keeps getting bigger.
Chris, do you tend to foreclose on properties, or are you typically trying to keep people in the home?
It's more profitable for us to keep them in the home. So a lot of people think real estate's, a net sum zero game. Note investing isn't. There can be win-win situations in note investing where you keep the home and it's better for us. Our foreclosure rate is, I'd say only about 10%. It's very low. And typically death or, basically people just don't want the property. Very rarely will we get into a situation where, we're foreclosing on somebody within that property. And if it is, typically it's because they just truly cannot afford the home, in the sense of like they can't even afford the tax payment on the home, never mind, a mortgage payment.
Chris, what do you know about sort of the end game for most of the borrowers? I mean, and like how long do you typically have a loan on the books? I'm assuming these are, frequently 30-year mortgages. So you could be, in a loan relationship with a borrower for a really long time.
Yeah, typically we hold our loans for 2 to 3 years. And the reason why is, back to that example, let's say we bought a loan for 50 cents on the dollar. We get them on a new payment plan. And what that looks like, let's say their payment was $1,000 a month and say they're $20,000 behind. And I'm just using hypothetical numbers. Maybe they can come up with $3,000 to $5,000 up front. And instead of $1,000 a month, hey, we can adjust your payment to $800 a month. And then if you make those payments for a year, we can permanently modify that loan to your payment now forever will be $800. And once we do that and they start paying consistently for about 12 plus months, we can then turn around and sell that loan back on the secondary market for 80, 85, 90 cents on the dollar. So now that we got them reperforming and back on a plan, it's kind of like, again, I'll go back to most people who think of real estate, buying a house that needs renovation, renovating it, and then turning around and selling it. The only difference is we're not renovating the property. We're almost like renovating the borrower, to get them back in, the credit to start getting it rebuilt.
And I imagine that's a great outcome for them. They get themselves back to a manageable situation. They get to stay in their home, and it sounds like it really is a win-win, which is something that I love about your strategy.
Yeah, and most people, when we try and work with them, their first reaction is very defensive because they're so used to other lenders basically like, hey, you're just trying to screw me, and you want my house. And I'll basically like, I don't want a house up in Pittsburgh, as an example. I got out of the rental business. I just want you to make your payments on your mortgage is really what I want, which helps you and helps me at the same time.
Yep.
And thinking about impact, what's the impact on their credit score? I've got to think that when they come to you, their credit score has already taken a pretty big hit. If they're able to more consistently make payments, does that improve their credit score?
It will. And one thing I'll mention too, a lot of these loans that we see, most people are so used to seeing loans at like 3-4%, back when, last 3, 4, 5, 6 years. even during those times, not everybody had, 660, 700 plus credit scores. So a lot of these loans were still originated at, 5, 6, 7%. So, so they already at that point in time when they got the loan may have not had perfect credit. So, that's one thing too, what people forget. And now, rates are, back at the 6 or 7s, but prior to the last, year or so when rates increased, what we would try and do is work with the borrowers to also try and get them a better rate to refinance once they got paying. Because again, it's a win-win where we would go to them and say, hey, look, we'll try and assist with paying some of your closing costs. And the reason why is, hey, look, if I'm going to sell this loan at 90 cents on the dollar to somebody else, and I can get them to refinance and pay 4%, I'm basically selling it at 96 cents on the dollar because when they refinance, I'm getting paid off and there's a new lender. And that's what's great about this business is there's so many exit strategies that you can do with the loans.
Sure. So Chris, when you first started buying loans, you were doing this with your own capital?
Yeah.
Is that right?
Yeah, I was using my self-directed IRA.
Okay. Now tell us a little bit about your journey, because I understand you as a company now, manage other people's capital. So just, what's your journey been like and what do you guys do today?
Yeah. So actually today is the 1-year anniversary of incorporating our company. So
congratulations.
So I've been in the note space since about 2016. And like I said, I started using my own funds and started with about $25,000. So it wasn't a lot that we started with. And today we're trying to raise $150 million. So over, 6 years, and to date, in the last 6 months, we've raised about $10 million. So in 6 years, we went from starting with 25,000 to 10 million, which I think is good. But, we started with, like I said, started with a few notes, and instead of paying somebody, call it a guru, $15,000 to go learn the business, I'm like, hey, look, let me take 25 grand. I'm an engineer by trade. I've been in construction, so I know how to value property. Kind of the title side is what I need to work on. So started buying a few loans, and then it's addictive to say the least, because you're, buying loans, like buying property, any real estate investors tell you it's an addictive game. So did that. Unfortunately, I had to take a little bit of sabbatical because I had lost my father about 6 months after buying my first loan. And then took a few months off. A lot of people who were taking these trainings were not following through. So I'd actually reach out to people at events and saying, hey, look, if you're not interested in doing this yourself, hey, partner with me. We'll do a JV deal on an individual deal. Most people at the time were giving 50%. I started, I'm like, hey, I'll give you 60%. So I gave them like, why me? I gave them a little bit more on the back end. My whole theory has always been when working with people, you need to communicate with them, the good, the bad, the ugly, whatever it is. And that's kind of my whole mantra is everybody needs to stay informed. And, I started doing that. And when I started taking on more partners, next thing I know, I have like 50 JV partners on 50 different deals. And I'm working full time while doing this, and I'm all by myself. And each JV deal is like its own little entity, had different books I'd have to report to and everything. Plus, I'm like, damn, this is hard. So that's when I basically had my attorney start writing up documents to do my first fund. So basically, he had all the documents ready, and a seller came to me one day and said, hey, here's a pool of assets. Rough numbers would be about $1 million to take this down. And it was a steal of a price. So, my podcast host at the time also, reached out to her and said, hey, we got to go raise $1 million in 2 weeks. And she just laughed at me. And I'm like, oh no, we're going to do this. And we reached out to everyone we worked with in the past and stuff. And we did. And we raised, $1 million in 2 weeks. And from, that was in 2018, and now we're in 2023. And fast forward to today, we've done over 500 deals. And we've got a fund, our company right now manages really, it's 2 funds, actually. One's a Regulation A+ fund, which allows for accredited and not accredited. And I can actually talk about it. We can advertise because we had to get registered with the SEC. And then we also have the typical Regulation D 506C fund that we actually just added that within the past month.
Way to go. That's fascinating and an inspiring story. So I'm really impressed.
A lot of gray hairs on the sides, too, that can go along with that. So
we can empathize.
Can you give us just a quick overview of those funds? I'd love to understand sort of just the basics of how they're structured and what kind of returns you shoot for, and just some of the basics.
Yeah, so I've always been the type of person I like to think I'm a little bit of an innovator and get creative. So when I was analyzing, and I literally spent like a week just studying like Reg Ds and the SEC website to see how people structured things. And one of the challenges with a note fund is, unlike a real estate fund, we don't have leverage because we are the bank. So if you're going to go buy $100 million apartment building, you might have $35 million in equity and $65 million in debt. So you might be, of course, the debt allows for more risk but greater returns. Because we have no leverage, our investments values is much lower on these because we're buying at a discount, but also means we typically have sometimes trouble competing with the multifamily guys. So we provide anywhere from 8 to 11% to our investors, and that is paid monthly. But what we did a little differently is a typical fund like ours, because it's considered interest income, you get the K1 and just tax it ordinary income, and a lot of investors who are accredited, are in that 37% tax bracket. So all of a sudden, they're paying 37 cents on the dollar for everything. So we got a little creative. I like to think we got creative. We structured as a C corporation. We looked at a REIT status, but unfortunately distressed debt and REITs don't mix very well because you lose most of the tax privileges. So we structured as a C Corp, but now because of that, now investors get a dividend, qualified dividend if they hold it for more than 60 days, which they basically have to, or 90, whatever that magic number is. I can't provide tax advice. So now all of a sudden, instead of paying 37 cents on the dollar, they're paying only 20 cents on the dollar. So if somebody was, basically our 10% versus someone else's 10%, ours is really more equivalent to over a 12% return just because of the tax ramifications of that. So we look at it for impact investing and passive, and we like to think we're also helping by doing the right thing by trying to keep people in their homes as well and create that win-win situation.
Yeah. I think you are doing that, and I think that's pretty inspiring. It's all single family?
99% of the stuff is single family. We've also acquired a few, like business purpose loans. We do have the flexibility to also hold some small, single family or some small multifamily in our portfolio. And the reason why is when you're looking to raise significant amount of money, you do need some type of flexibility. If all of a sudden, we raise $50 million and the note space completely dried up, we can pivot into, other asset classes that we have expertise in, which, for me, it's, real estate.
As you continue to grow the company and just think about vision, where do you want to take this thing? You've got your Reg A and your Reg D funds, and
yep.
Yeah, what's the vision?
Yeah, so our vision is eventually to get, stay between, I'll say today's dollars of like 150 to 250 million. And the reason why I want to stay within that realm is we have 10 employees right now. I don't want to have 50 employees because then I just become a human resources manager. I've worked for companies like that. And then secondly is, as you get larger, you can't spend, if you're taking down 1,000 loans in a portfolio, you're not looking at every loan. You're basically doing a blended portfolio of, hey, here's kind of a blended rate. You win some, you lose some. I'm, very analytical and anal in the same point where I want to look at everything. So we want to look at every loan on a case-by-case basis, which at that scale, we still can. But if all of a sudden we were a multi-billion-dollar company or a billion-dollar company, then, it's a different play, but, there's nothing wrong with it, but for where I want to be with the company. Plus, I think we also fit in a niche where there's smaller companies and there's really big companies. When you get into that middle ground, you have less competition sometimes because it's when you get real large, sometimes it's easy. And then when you're small, it can be a little bit easier, but in that middle ground, it's usually harder, to maintain a business. And, our whole team loves, everybody, my team is awesome. And we all work really hard. So I think that gives us part of our competitive edge.
Tell me about the scenarios where you do end up in a foreclosure situation, that 10% or so of the time. What's that look like?
Yep. And it's not always a negative. For example, we have a property right now where the borrower passed away and the family's across the country. They're like, we want nothing to do with this house. Like, it's, my parents, they were elderly. It's, basically still got the wood paneling on the walls and, probably the shag carpets and, the pink tile in the bathroom with probably carpet in the bathroom. So that's what my grandparents' house looked like. So I don't know if yours did. So, there's instances like that where, unfortunately, though, we still have to go through a foreclosure process because there might be other liens on the property or, they'd have to go through probate and it's faster for us to actually go through that process. But there are instances where, we've had borrowers, some of them use them as rentals. And that's their whole play is we'll buy it as a rental. We'll collect as much rent as possible from it and just let it go to the bank because some of these large lenders will let them go for years. In Florida, I could talk a whole conversation about people buying HOA liens, turning them into rentals because it takes so long to foreclose and just collecting rent, not paying HOA fees. So you pay $5,000, get $1,000 a month in rent for like 5 years, and then they walk away. That's a great little gig. But, there, on a rare occasion, we will have some borrowers who are combative that, basically think that they are owed something or they've been treated wrong or whatever case may be. We'll try and work with them, but it's got to be a win-win situation where they need to, basically step up and start, making some commitments. And if they make commitments, we'll of course make the commitments. And that, of course, doesn't happen in every situation. And if it doesn't, we'll get our legal team involved to go through that process. And depending on the state, it can be anywhere from a 6-month process to, in New York, you're at like 5 years, which is a reason why I probably stay out of New York. Pennsylvania, where you're at, is typically, about 1.5 years is, what the process would look like.
And the loans themselves, are they typically conventional or are they FHA, VA?
Yeah, mostly conventional. Very rarely do we'll see some FHA loan, but those are usually securitized and left for the really big players. But most are conventional fixed rate mortgages. Once in a while, we'll see some adjustable. And also we'll only buy typically we'll only buy first position liens. So there's other types of loans like home equity lines of credit or second loans, which were big 15 years ago. We want to be in first position because I'm a control freak. And when you're in first, you're in control.
Sure. And do you have any desire to get into other kinds of asset classes like commercial loans or anything else, or are you pretty straight and narrow? You can grow and be the size of business you want to be without having to. Yeah,
within our business plan, we do eventually want to get more diverse. One is not only in loans, but with business purpose loans or other types of loans as a vertical. Eventually, and when I say eventually, I'm not saying today, tomorrow, but years down the line, get more into a little bit into some real estate development because that's kind of what I had done for the 25 years. Love developing, love building, projects, building buildings and making an impact on the community. So that would be something eventually that I want to get back into as well.
Okay. Do you have any geographical concentration in your portfolio?
We've been in 42 states, and the only states we haven't been in are Alaska, Hawaii, the Dakotas, Montana, New Hampshire, and like Rhode Island. So basically, the only reason we haven't been there is because there's not a lot of loans there. So the unpopulated areas, or for example Hawaii, is such a small island. But yeah, I mean we've pretty much been in every state where we've seen significant inventory. Now there's states we like a lot more than others. But we've, and we always adjust our pro forma on our assets to account for changes in state regulations, which is something that's different than real estate investing. You're buying a rental in a certain area and so forth. Kind of you can run your numbers and know what your rents are and some taxes and costs. For us, foreclosure timelines are always changing, which can impact court fees maybe changing, or, there's so many things changing at a state by state level. There's a lot more monitoring and adjusting, your bid spreadsheet or your pro forma to account for all the changes that are constantly occurring.
And with a team of 10 today, I'm thinking about, this is a complicated business. So like, what do you spend your time on versus what do you kind of hand off to your team, or what do you enjoy most when you're rolling up your sleeves and getting into your workday?
Me is the pursuit, going after bidding and due diligence on the assets, kind of, and then figuring out, okay, what is our exit strategy and what is a creative way we can work with this borrower? How can we get creative? My team calls me the squirrel because I'm always coming up, chasing, kind of a shiny object, on something or trying to figure out a way to be creative. So our team consists of, we have investor relations, which works with raising capital. I'm an engineer. I'm not a salesperson. So you can imagine kind of engineers, that's not what we like to do. And that's where I have a team, and one of my business partners, Lauren, she runs that whole investor relations team. So we have that department. Then we have one woman who runs operations that basically coordinates a lot between asset management and and our investor relations team. And then we have an asset management group, which has 3 people in that as well, that manage the day-to-day, and have a woman who oversees a lot of the bidding and strategy and getting loans into our portfolio. And then, I manage, of course, all of them, but in my free time, I'll work with the asset management side, like I said, looking at the numbers to see, okay, are we competitive on these, and how can we continue to acquire more assets?
Cool. Yeah. Well, I feel like I have had a decent education here today. This has been really, really awesome. So I think, we've had a chance to learn a lot about the business. I'll hand it off to Andrew here as we start to head towards the tail end of our episode.
Yeah, thanks, Dan. Chris, really fascinating stuff. I feel like I have a good sense for how you create win-win situations with your client base. So let's get to know you personally a little bit.
Sure.
First question is, what would you say is your biggest win? Maybe something personally or professionally that you're most proud of?
Yeah. So overall, from kind of a life story, it's abilities to overcome your biggest failures. I've always been able to, when I've been unsuccessful, to pick up myself and continue. Professionally, my biggest win was I had built a building for the U.S. Government and U.S. Army. It was their legal services office building and courtroom, which we had to design and build it in 12 months. So it ended up being about $40 million back about 10 years ago. And anybody who's ever dealt with government contracting knows to try and get an answer decision from them is pretty difficult. So we literally designed and built that building in 12 months. And my boss didn't think we could get it done. And being from New England, and he was from New England, I actually bet him that if I finished on time and the Patriots go to the Super Bowl that year, he's buying me tickets to the Super Bowl. And lo and behold, we finished on time. Patriots went to the Super Bowl. Unfortunately, they played the Giants. And anybody who follows football knows how they fared against the Giants in their Super Bowls. And is being able to now be there for my family. Being able to work from home and have my own business to create the time and flexibility. I have a daughter in college. I have a son in, 6th grade. So being able to, spend time with them, go see their sports. And, my daughter comes home on a weekend or whatnot, spend time with them and not having to constantly always be working.
That's awesome. Does your daughter go to school near you?
She goes up in Philly. I did want to jump.
Okay. I see a favorite movie or favorite TV show, anything like that?
Yeah, so the movie always goes back and forth, between Top Gun and Shawshank Redemption, or the two, the two. I've seen Top Gun a lot more, but, Shawshank is on like TBS or something. That channel's not moving. That remote just freezes.
Yeah.
So.
The original Top Gun or the new one?
The original, actually, but the new one was really good as well. So I could still watch that one. Actually watched it with my son the other night, first time, so he loved it.
Nice. How about favorite food? What do you like to eat?
As I've grown, so right now, my wife is from Uzbekistan, which I didn't even know where that was until I met her. So they have a dish called plov, which is like rice, lamb, chicken, and basically a lot of herbs in it, which is very, very good.
That's awesome. I learned about a new food and a new country today. So pretty incredible. How about a current growth edge, a way that you're looking to grow personally or professionally?
Professionally, it's really by the team that we're putting in place. and me stepping away from the day-to-day and relying on this business. So when we brought people on board, we brought on people who were very talented and we could teach and learn. And by bringing on people like that who are just very competitive as well, it allows us, everybody fits a very nice role, kind of like a sports team, essentially, of playing a different position, which allows everybody to grow.
Yeah, and that makes a lot of sense. I know you have a podcast, so what's the name of your podcast? And is there any other like A+ content that you recommend folks listen to or take in?
Yep. So we have a podcast called Creating Wealth Simplified, which I hate my voice, so I don't listen to it. I really like is the All In podcast, which, it's by 4 entrepreneurs. It's a really good podcast about everything going on in society, and there's 4 people from very different perspectives of life that can provide a lot of insight and value on markets, investing, just global impact of things. So some really, really high level people that you can learn a lot from. It's almost like a TED Talk every episode.
Yeah, no, I love it. Well, awesome. Thanks again for being on the show, Chris. Thanks to our listeners for listening in. I know I learned a ton about note investing that I didn't know prior to today, and also really appreciated how you think of impact in your industry and keeping people in their homes and generating win-win situations that benefit your investors and your tenant owners. So thanks for your time, Chris. Thanks for being on the show, and thanks everyone for listening.
Thanks for having me. Take care, everybody.
Thank you for joining us for this episode of the Real Returns Podcast. We hope that you learned something new about how you can invest to make a lasting impact on those around you. Please be sure to subscribe to our show wherever you listen to your podcasts, leave us a review, and share about us on social media. We hope you will join us for our next episode, where we will be continuing the conversation around impactful real estate investing.